All right, we're live, dude. We've never done this live. We got about close to 200 coming in here.
This is incredible. First time going on, but I'm happy to be here. Happy to do it.
So we got to kick it off. For those of you who've known, I got out of bed for this one. So that the Michael Jordan MJ sick game here. I got out from COVID feeling a lot better. So thank you for everyone that helped out and gave me great advice.
We got a sheet here with a bunch of good questions from our tweet that I think we just pull through, but I mean, look, there's already a bunch of questions, obviously.
All right, Tony. So why don't we start out with the first one? We can go through some of these and then we'll ask questions that pop up. People want to raise their hands and go live and ask the question. We're going to be recording this. This is actually going to go, as on the podcast. No edits this time. We're going raw. The first question, Tony, is from @Kulada05. Tony, I want to raise cash, but with so many SPACs from the Bible near NAV, it will be wrong to sell them now. Is that correct? I appreciate all the insight. I do plan on holding a few of them higher for the conviction ones.
Yeah. So this is a really good question, and something I asked myself too in the last the last few weeks of the crash is you buy these SPACs near NAV in order to use them for cash in the future. If you were if we have this nice dip and you see some opportunities and you want to get in the market and stuff, it's nice buying something at 10, 11, 12, and then, it goes back to 11 or 10 or whatever it is. It's that's gone down less than TDOC, TTD, Roku, all these big buy and hold long-term investor names have also gotten smashed, right? So I think, first of all, it's people are looking at SPACs as a bubble. SPACs can't be a bubble. They're an investment vehicle. It's what goes into the SPAC could be a bubble. But the actual method of using a SPAC to get a company public is not a bubble. So when people say that, just completely ignore that. It's not real. But I do have a lot of positions, I got HAAC still, and that's come down quite a bit, right? But once again, I've been in that since 11 and it's gone to 15 and now it's back at 11. So I'm looking around here to see what else is really looking attractive to me here that I could get into using that cash if I want to, part of it, maybe all of it, or, for example, Ajax. And I'll talk about this tomorrow, was one of the SPACs I held a lot of cash in, but I had that from NAV recently, been adding to that because it was always trading at a premium. But then they just announced this deal for another used car dealer, VRM, Carvana type thing. It's crap. I'm going to dump it just because I just don't like that industry. It's just not what I'm looking for, right? The team came out with so many good things. Who the management looked like they were going to pick something so great, right? And then they picked something that I was not looking for. And so that's a perfect opportunity for me to be well, what can I buy that's better than Ajax? So I'll dump my Ajax just because the target wasn't great. And then I'll get into something else.
I'm in tech and I still don't know how to even use Zoom. There we go. We're back on live. Super helpful. And I think this one's actually obviously important with everything that's been going on. @Boo Carney was saying, Anthony, can you talk a little bit more about these rates? If interest rates continue to go up, are hyper growth stocks such as SPACs, EVs, non-revenue companies, are these all going to be toast, do you think?
All right. So there's two ways to think about this is do you want to be buying things that you believe in or things that you could be a decent investment in terms of making 5 to 10% or being flat? There's a different investor for both of those answers who say yes. So for me, I look for high growth, but I also am cognizant now that it's not the same market it was, because what happened was, and I've been saying this since the beginning, and I said this is the only reason I would get ever bearish, right? This is what I've been saying since June of last year, the first episode of the pod. Nothing will deter me from being as bullish as freaking possible until it's something to do with rates, until it's something to do with bonds, liquidity, purchasing, something like that. That's actually a structural, tangible thing that affects the macro environment. Everything else, the stimulus, this, that, all the crap, yeah, it feeds into it, right? The dollar going down, all that is part of the macro environment. But for me, the big thing was rates down is super bullish, super expansionary, right? Fed buying 120 billion of bonds and swaps a month, very, very bullish. But here's the thing. If they stop doing that, you don't know what's going to happen with rates right now because it's not the Fed raising the rates, right? The Fed said, we're maintaining low rates until we get to a position where we are completely back to pre-COVID economy. So, granted, the unemployment number is 6.2%. The unemployment number is bullshit. It doesn't exist, actually. If you think about the discouraged workers, who are people looking for a job for more than 6 months, they're not counted in unemployment, right? They're just pushed off to the side. So it's very different if you're saying, well, 6.2%, right? But how many people lost their jobs and didn't get back into the economy in the last 6 months from this happening. And now they're trying to get back into the economy again. So maybe they rejoin the workforce, or they're just not looking for a job at all and just like continuing to live off whatever amount of unemployment. It's a very big difference for that. So what I think is that the rates of like that we're seeing in these rates, like the rates for the 10-year, the rates, like those kind of rates are the market participants expecting that the economy is back to being really, really strong, like already today, right? Like 1.6 to 2% rates is pretty standard on the 10-year, but we are still a ways away. And I think people are overshooting the expectations for a strong economy. And the whole argument with inflation, and this is my answer to that. If we're looking at a basket of goods, right, like CPI, or like, it's not the same as saying, how much did my rent go up? How much did my health insurance premium go up? How much did my phone carrier bill go up, right? Like, it's a different basket of goods. So you have to also understand that if you were really to look back and see like, what's inflation been over the last 30 years, you really don't know, because it's not properly accounted for, in my opinion, right? So there could have been all this inflation happening the whole time, right? You see real wages haven't moved up in a long, long time and are finally starting to come back up a little bit, but still are like well under what inflation has been actually recorded for since like the 70s. So all of that being said, it's ambiguous is my answer, because if you think that the rates are just going to continue going up, like I don't think that's going to happen. Like the Fed can still do Operation Twist, right? They can change and bend the yield curve to make it more attractive in the way that it's not right now. However, I don't think that like Roku is going to trade at 5 times sale. Like I don't think that these things are going to happen for the long time, because these companies have gone from growth to value and are now becoming these Godzilla companies that will be churning out a lot of profit, that will be churning out consistent revenue growth and beats on all their earnings. So there's a lot of shit stocks that came out, sure. But am I bearish on the entire market because rates ticked up, 55, 60% on like the 10-year? A little bit recently, yeah, like it's not really a great thing to see. It's a bit concerning, but I also think it was a front run of the stimulus, which just got passed. Like if a stimulus got passed in Trump, how is it not going to get passed in a Biden administration? So for me, that's what I see. I see this comment. Seems like there's so many deflationary forces to rate against inflation, even excluding the pandemic unemployment. That's really true. There's a lot of deflationary things that are happening on the ends of the pandemic, which is still ongoing, right? We still have the same number of cases since April, June, July. Like it's not all out of the woods yet. And even then, people don't just stop being in this, paradigm we've been in for the last year.
Awesome. We got a really important question. I'm trying to monitor here as well. We got a big question. Is that an ARC hat AO is sporting?
No, it's a Peak Life Capital hat sent from two of my good friends for my birthday.
Very quick one. All right, we'll do one more out of here and then
on the back.
Okay. We'll do one more from here. And then if people want to raise their hands, I think it'd be kind of cool to get some real audio and questions as well. Let's pop in over here real quick. I saw a good one. Well, let's talk just in general too, because obviously the big news last night, 1.9 trillion in stimulus, Tony. Is there a possibility of a bull trapped right there? Like, is that even possible now with 1.9 trillion?
Right. So, I mean, the whole thing with stimulus is that, like, because you get stimulus, like, that's just going to, like, propel people's idea of the economy, like, getting better, right? Like, if you didn't get stimulus, it would actually make the economy, like, look really, 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 really good, but people would take it in the bad form. So everyone was expecting the stimulus, so therefore, like, it had to come. But I think that the things that you saw in the last week that started at the 7-year bond auction, like 2 Thursdays ago, that went on into this, were all related to some part. So I really want to see how it plays out tomorrow. What are we up in futures right now? 1 second, let me check. We were up like 20 when I checked. Now we're up 9, right? So it's already selling off. I wouldn't think we just go right back to highs here on the S&P. Like, even though the markets came back on Friday, the S&P snapped back. But, the NASDAQ still wasn't doing fantastic. It's still like off 10% from its highs. So it's got a long way to come back versus like the S&P, which is only a few percent off its highs.
Awesome. All right. So we're going to do this. This is my first time trying this. So I apologize if I'm mispronouncing anyone's name. Abdel Kader.
Hey, what's going on, Avi? Thanks for
what's up?
Unmuting
this
me.
Is awesome, by the way.
Yeah, I love it.
This is
what we should do this every week now. This is so much better.
I'm glad to be here. I actually had a question, not really related to any of the stimulus that's going on or that, but it's actually a question where I was wondering what happens when a company buys out another company at a higher stock price than that company's at, and then what happens to that stock at that specific time? Like, is it possible for that stock to go back down, or does it just become like liquidate into the other stock price?
Yeah. So if like if a bigger company says they're going to be buying a smaller company, right? Like let's say the stock's trading at 20 and they say they're going to be buying it for, let's say it's trading at 20 and it's worth 20 billion. And they're like, we're going to be buying it for 30 billion, cash and stock, whatever. And then the stock would shoot up to 30. And I've seen that happen a lot. Like that happened with, like over the years, LinkedIn and a bunch of other companies I've seen like get merged, like big merger acquisitions like that. But primarily what happens is because you're paying a premium to completely acquire a company that's growing at a good rate, which is usually what happens, right? You don't usually buy a crappy company if you're trying to expand your own margins and move into better spaces at a faster rate. So the price of the smaller company will go to whatever price the deal is at. And then the bigger company usually, like you've seen that with like, for instance, Salesforce recently, that's come down because they acquired Slack at that like high valuation.
All right. We will get better at this, by the way. It's still a technical thing. All right. Looks like Rahul Hemrajani is next. And again, I apologize.
Hey.
I know I'm going to butcher these names.
No, thank you, Avi. Thank you, Tony. Big fan of you guys. Feel better,
Thank
Avi.
you.
I'm in Jersey, not too far from you.
Awesome.
Tony, I asked this question, so I'll just repeat it. I think you may have seen it. But you've been like the first one to pound eVTOL, space, and genomics are like your future favorite sectors. And I think we all love some of the names like Beam, Bingo, even Lilium coming potentially with Quell, and you have EH. So now with all these yields changing, I mean, Kathy's buying up Beam, but like overall, like these two industries, and even Hall, I know that's like a big space one that
are you talking about genomics, or are you talking about like eVTOLs or just like,
eVTOL, genomics, and space? Yeah, in general.
Okay.
Like,
Yeah. Like my three favorite sectors.
Three favorite, like, how are you playing going forward? I saw your tweet earlier that, you have some names that you're consolidating into.
Mm-hmm.
So those are amazing, but just trying to figure out, how to navigate this. Like I know you're playing ARKG for genomics. So are you sticking to that now instead of being individual? So just overall.
Yeah. So that's a great question. Like I think what happens is, when the market drops the way it does, it's like in March, what I learned is that crash allowed for me to see relative strength and allowed me to really decide what I wanted to be in. So there's been so many names that have happened recently that have just like came and hit the market through a SPAC, or have just been recently discovered and been becoming like, a FinTwit name or an important name for a lot of investors. But the whole point of my tweet today was thinking there are so many companies in all these spaces, right? And I think that the majority of them that we've been talking about will do very well in the long term, but in the time where you don't know if, it will become a much more deflationary environment, right? If the expansion starts getting tapered off and rates go up, like it's become less easy is all I'm kind of saying. And so when that happens, you want to figure out what are my weaknesses, right? So my weakness might have been having a lot of stocks that have valuations that are coming on in the future, right? Like, so I just got a question here. Like, are you still bullish on Nanox? Yes. Like I've loved all the, you've seen it get closer and closer to FDA. Why would they be producing 25 machines if they're not going to get approval, right? Like the expected revenue is 1.2 billion in 2024. Once they get those five, they're looking like they're going to be doing exactly what I want. And so that's like the second branches of the bonsai tree, which is, safer, but still risky, versus like SC, which we know is a proven, thoroughbred beast. And so like for all those like space names, for example, I think my thing was looking for the ones that have a niche, because there's going to be a lot of different companies that come out and do the same thing, right? Like you have like Rocket Labs and you have SRAC and you have SpaceX, but like SRAC does a little bit of a different thing. And then, you look at Helicity and like Astra, and like that for me is like, that's when I'm probably going to be keeping in the 25. It's just, there's so much abundance of great names. You have to be very, very, critical in what you want, and then structure your portfolio based on the amalgamation of all of them, right? So you have like all these names that could be either, like C, I think is going to start crushing in terms of like EBITDA and just net profit is just going to start really killing it. So that for me is getting on the much safer end, especially if we get a value contraction. Whereas like some other companies like Quantum like DMYI, right? Like that for me, I think is, the quantum computing is a huge angle that is like very, very untouched in the market. So like I will be dipping my hat into that, but I'm not going to be allocating a huge amount to it as I would have probably a few weeks ago, just because that's not going to have revenue for 2 or 3 years. However, they're still doing something that I really like to see and I want to see is quantum computing hit the markets in like, a single like company that just focuses on quantum computing versus like having little aspects of it. So that's kind of the way I'm thinking about it. And for me, it's just like, if we do get a value compression, how much is it going to go down, in terms of the compression, right? We already saw rates go up a ton. And like, while things did come down, like the pound in the table Bible is still positive, like 1% for the year versus like ARC's down 6%. So it's a little different for me because I do have my portfolio spread between most of the names in the Bible and then some other new names. But I'm always looking to see that value compression, if that's going to last longer and longer, and see what's holding up super well during it, because that's what I want to be in the next time the market's fantastic. I want to be in, like, for instance, skills is on my list because even though it went to 46, right? It only went back to 27. And that was also a SPAC that could have gone back to 10. But because of the NFL partnerships, because people know they're crushing the increased user rate, you go on Google search trends, it's up, stuff like that is holding it up because people want to be in it. Plus Kathy's buying it. So there's a lot of different things that are going on with certain names that I like more. And so I'll just be focusing more on making sure I have the exact perfect positions that I want to have moving forward versus just having, a bunch of different positions that I know could probably work out, just less likely.
Mm-hmm. Cool. We'll pop back and forth from the chat and from people raising their hands. I saw, I think, where did they go? Maybe they just dropped their hand now, actually. There he is. And again, it may be Karen or Karan Verity. I will unmute and you should be able to go. Maybe they're not. There you go.
Yeah.
You there?
Hey guys, how are you doing?
Awesome.
Hey.
Thanks for joining us.
Yeah, I started listening to you guys back in November last year. So to Tony, like his bonsai principle is pretty sick, and I'm really following that in my retirement account. I'm 30, so I'm still planning for that. So my question was in terms of a technical analysis, Tony.
Mm-hmm.
So when I look at these, like ARC is a poster child of growth stocks, right? So when I look at it now, it's from last 6 months, it didn't have any consolidation on monthly. So now when you start looking at it in January, February, March, it's having a consolidation. So it has almost like my retirement fund out lost almost like 40% from last 2 weeks. And so do you count that part in there too, in technical analysis, when we see that there's no consolidation on monthly, and now that's happening, and which is healthy, I think. So I just wanted to point that out, because even Russell 2000 is doing the same thing too. Like they all are doing the same thing, and it's just Kathy is forefront of growth stocks, so she gets bullied by all these people at the Wall Street. So I just wanted to point that out and just see what do you think about that in terms of consolidation.
Yeah. So I did post a chart on Friday about ARC, and so like the way that I want to just frame the way I do technical analysis is, it's a big part math and it's a big part psychology. And I combine the two and I try to make it, behavioral finance, like it's the major I created at school so I could study this kind of stuff. But you see, like ARC went from, it bounced at the September growth stock lows, and then it bounced at the election lows on that trend line. And then it bounced just now on the same trend line, right? And it's just been a random drop of like 165 to 106 at the lows and bounced to 117. And then it closed at the VWAP from March. I mean, like, it's just, that's like a triple whammy, like psychology, math, and then visual psychology. So those are the things I like to see for technical analysis. And then I do like your point of like looking back on monthlies and weekly charts and stuff, because that actually does tell a huge part of the story. Because when I do VWAPs, I do it at a different like time span. So I'll start it like, let's say like, I could actually just chart. Should I chart live? Yeah. Okay. I'll do it.
Doing it live, Tony.
Yeah. It's easier to explain if I just like talk about it here. I'll give a good example. ISRG is like a really good example. I like the stock too. I just like the example of like picking a more random VWAP to make it work the right way. Is this all good?
Yep.
All right. So like, if you go you know, for example, we can start at the monthly, right? So I think every chapter of a stock is based on a couple things. It's based on like if any news or anything that really disrupted or changed the story happens, then like you consider that like a big difference in who's actually buying and who's actually selling, right? Because every time something happens, it flips in terms of like who's selling and how much they're selling, or who's buying and how much they're buying, and then ends up being how much everyone's holding. And so I think of it as like, you know, I said this before on the pod, the chapters in a stock's life. And so when you're looking for like the utmost support, you go back as far as you can. And like you instead of doing the daily or, you know, the hourly VWAP, you'll go to the daily and then the weekly and then the monthly. So the further back you go, the stronger the VWAP is. That's what I've found to be true. So I always like to see like, where's the story of the stocks, right? Like this is you could think this is one, right? But because it went over and then went back under, there's a new base. So like, this is probably where I would just start messing around and see if things line up. And so, okay, like this is also consider the time, right? Like 2010 to 2016 is a very different environment than we are in today. So, but until then it did, if had you done a monthly VWAP here, it would have held on ISRG until then. So let's try another one. So I look for patterns where it's breaking up. So you see how like this was a fake out, right? And then all the guys who bought here, right, when it's even like this and it goes lower, all the guys who bought here, they were distributing here, whatever, this is all crap, and then they dumped it all here, right? This is 2008, 2009. And then so I a lot of my charts start from like 2008, 2009 bottom, because that's a new paradigm of buyers coming in after a big correction. So until then it held really well. Then I probably go closer here, zoom into about right here, and because that's the day before the beginning of the next move. And so, and I actually would definitely recommend everyone like check out Trend Spider. I just don't know why I didn't use it ever before, to be honest. So once again, see, like, had you started it from there, you would have caught this bottom, but then you see there's a different acceleration, right? So this is one type of buying. This is a very different type of buying. And this is a very, very different type of buying. So for me, like that kind of buying began here. So I bet you if we try from here or from here, this will line up. So I'll try it. I'm just trying to like walk through, folks. I guess. Right. Okay. So see, literally like what like dangerous. You can't time the markets. That's BS. Like I think that whole thing is kind of crazy to me, because like anytime you do anything in the markets, you're effectively timing something, right? You're causing change, and all time is change. So like anyway, that's too much 4D. I'll just stop it right there. But see how it stopped right here, like at the perfect level. And this is the March 2020 crash, a completely random like left tail event, and it still held the VWAP from the beginning of the next chapter of people in the stock, right? So it's like you can think of it as like a sports team. It's like every year you get different players. Maybe some of them are the same, but you know, you still get the draft. Is that good, Avi?
You got that one.
Okay, nice. But yeah, and then like then you just kind of can do this on any time frame, right? So I do this on a monthly now. You could do it on a weekly. I'll show you the daily, because it's just ultimate proof how beautiful this thing is. Like, think about like here, this was just so much capitulation and craziness that nothing was like set in stone here, right? Like everyone who was here needed drinks at the end of the night. So no one really, you know, there's a ton of buying and selling here, but this is kind of craziness. And you want to wait for the buying to settle out, because that's when the real people will stay. And that's when the people who are just manipulating or playing the stock because, you know, like downward squeeze or the big fast rally up on the coronavirus have left the stock. So you started from here. Like this is like, I think this came around some Fed news, I believe. But regardless, like this is the change in the stock, right? You see this consolidation pattern, explodes, and then it explodes again, right? So you technically should do another one from here. And you see that it likes to ride in between the VWAPs, right? So it means on average, it means that these buyers are way stronger than these buyers. And so, but you see here, like 1 touch, 2 touch, 3 touch, 4 touches. And you do enough of them, and over time, you figure out which ones work. And then the more and more that you do them, you can figure out the different specific nuances of different charts based on time frames.
Got it. Thank you.
Awesome.
Yeah, I hope that helped.
All right, we got Ross Berman. Ross Berman, for folks that saw that amazing song. I think this is the same Ross Berman. So I'm gonna have you unmute. Maybe if you can ask the question with the guitar, that'd be awesome.
Oh man,
Ross, you there?
Yeah, I'm here, Avi. Thanks for having me on, and feel better. Yeah, don't have the guitar with me, but Anthony, I'm just kind of curious. When you're looking at the markets, how do you enter in a position? Like, are you waiting for the absolute low, especially with these SPACs where the rumors can really, tip the price a lot? Are you waiting for the perfect time, dispersing, or just doing it all at once and trusting your thesis?
Yeah. One thing that I have learned, and so back in December, and also sick song, thank you. But second, back in December, I got this like day trade call on my account because I was like moving too much money around in the account, and so like I could only buy and sell the cash that I didn't already trade that day, and so that restricted my trading a lot. And I could have gotten rid of it, but then I realized it could actually help me a lot to think about what I really think about when I want to get into stock, like to your question. And so what I learned is that things freaking regress. Everything is a mean regression in the world, in my opinion, and like balance, all that stuff is like the center of what is all happening here, right? Like if you think about it, right, like someone's making money, someone's losing money, the middle is where that always meets because that's a net even, right? Like that's no one's plus one, no one's minus, right? It's zero. But like you have wealth creation and this and that, but like in the game of trading and how this works in people's minds, it's that kind of like almost zero sum game, but it's a little different. So the way that I think about getting into a position is there's always rotations that I've been noticing so much more in the market since the coronavirus happened. Like since March, it began with like the Russell lagging so much, but calling the bottoms. And then the tech was leading and then calling the tops. And so I like to look at those rotations as like the first thing, right? Like right now, the NASDAQ is down a ton. And I think that it's overdone in terms of like the rates and everything. I just think they were prepping for this to happen. And they was like buying into the rumor and then they're going to sell the news, which means they're going to go long bonds, drop yields, and then our techs are going to get better. That's my opinion. I could be damn wrong. I don't know. But I always look for something like this is usually like if I don't get a value bottom in terms of like there's volume there, there's people who have already been in the game right there at the stock and it's reverted back to it. And I can see the bottom and I can see I can see the buying and the selling versus the stock, right? It's like a tug of war. And you can kind of tell, right? Like the market's been flushing and flushing and flushing. And then on Friday, it would move up, it would go down a little bit, then move up versus the other way in the last few days. So I look for price action and I look for good value zones because if you really look at like, what's a good one? Here's a good example of one. Like I like MGNI. I was in it at 9. Like I unfortunately sold it early at like 30 or 32, but I mean, it's way higher now and it went even higher. And if you look at I got too many names on here. Here it is. So if you go to like the chart here, you can see, right, like people were like, oh my gosh, I want in. And then it mean reverted because that's just how that works. Like the people who make this kind of money, most 90% of the time don't stay making that kind of money because they'll get out of it and they'll move into another position or they'll trim right there, which will naturally just bring it down anyway. Like I think that's for me, like I hate getting caught up here. And I used to get caught up here until that day trade call, which made me trade less. So I think a lot of people overtrade. I overtrade and I am considerably down from like trading amounts. Like I don't trade a lot like I used to. And it's still like a little bit of an overtrade because I noticed there's so many of these opportunities that come over time if you're patient. And so I think patience is a huge thing for entries. You could just see like things ride math, right? Like the reason there's a volume average there is because that's like the middle price that everyone's paid and everyone's sold at since it started moving that way. And so the most logical place for it to revert to is the average, right? Like people on average statistically are more like centrist than they like to say about a lot of different issues. And that for me is like just a factor of psychology. And so I use that for entries most of the time.
Awesome. All right. We're going to go with Amin. This is going to be tough to pronounce. Yelazarov. Let me unmute. Let's see here. It's not letting me unmute that one.
Is the chat off for people not in the
chat? I'm here.
Like...
There we go. I'm here.
Hey.
All right.
Hey guys. Great job with the podcast. I listen every week.
Thank you.
Avi feel better. Tony,
Thanks,
quick
man.
question. I follow Beth Kending very closely. She is amazing.
Mm-hmm.
I do not own the stock of Zoom just yet, but her work is fantastic. She mentioned that Zoom might have some hardware coming out and how she's just so bullish on Zoom with enterprises switching their whole systems to the Zoom platform with phone numbers and connectivity. What are your thoughts on Zoom going into the S&P this year, and B, if it does, do you think it will have a massive run up like Tesla?
Yeah. I mean, I think Zoom deserves to be in the S&P 500. I think that I've never seen a company crush so many times so hard and so consistently. So, and also the entire theory that, like, for instance, like people say Etsy's a mass company, like clearly they got wrecked in that report where they did like 100% something growth and they were projecting 13. I think Zoom continues to outperform because people continue to miss the ball. And why is this so bright here? Sorry. And the ball is that people are not really looking into how the future is actually going to go from what COVID's like cost. Like, I don't think that there's ever going to be that much like square footage to non-square footage of people working ever again for commercial versus like at home working. And I think that that's just going to continue to drive the use for Zoom. And also Zoom now is getting like very profitable, and like it's going to become a consistent revenue generator. And it's not trading at this like hundreds times sales like it was before. So I think that Zoom will get added to the S&P 500. It's just a matter of when. And I think when they do, like, you will get a run like Tesla, because Zoom and Tesla used to be like synonymous with like Rippy mode expansion in the market, because that is like, those were the two stocks that everyone was really going crazy on, I think. And I think that that's just, like, you saw Tesla came down a bunch, but right, like, what did it even, like, who cares? Like, it went from nothing to everything. And so the same with Zoom, right? Like, these things are not going to go straight up all the time. They're not going to go parabolic all the time, but news like adding it to the S&P 500 forces it, forces it to be bought. So
I was just going to add too.
I'd load it if that happens. I'm going to load it if that happens, most likely, just because like I've been waiting for that to happen, because I remember how great it was when Tesla did the split and how just you could see the consistent, FOMO of being in the S&P 500 and owning Tesla, and some of the funds that were front running the ad and all this is happening. I think that could happen similarly in Zoom. So I'd probably be playing that if it happened, but just whenever it does.
Yeah, and I would just add too. I mean, so I think you had mentioned like where else they could go. There's been like rumors they're going to kind of add in like an LMS, so that's like a learning management platform. So you could like already send some documents, but think about that kind of taking that next stage too. I mean, my fiance is a teacher. I know that the students can then share their work, right? So that could be all throughout education. That could also work in business. So it'll be interesting to see definitely where that goes for sure.
One more quick thing to add, it is $98 billion market cap and it's ubiquitous. So to me, it's almost like a matter of when, not if. So
yeah, I really do believe with you, like it's going to get added to the S&P 500. Just like, I mean, Tesla was hard to get in the S&P 500, but I think Zoom will actually be a little easier. And I think people are just going to have to actually revise their estimates for a ton of these companies who are just crushing the output that they're under, like, and they're underestimating what they're going to be doing in like Etsy and like Fiverr. Like Fiverr is one that that's in my like going to be holding that for a long-term portfolio, just because they're expanding into so many different things that I could see them becoming, a multi-pronged company that's just digging into all these cookie jars. And I mean, Zoom's now making the money. It's got the name. It's got the, like, literally it's a verb. That's a huge Avi indicator. Yep. So yeah, I mean, like I do think out of the other ones, especially since Zoom's gotten sold off so much recently and they had like that earnings report, like that to me is like, I like those setups where people misinterpret what's actually going on, because usually when everyone's not on the ball is when it's rolling the most.
Zig when others zag, Tony. Dooley looks like they've been waiting a while. Dooley, if you're on still.
Hey guys, appreciate what you're doing here, and really enjoy listening to the podcast, learning a lot, and again, kudos to you guys. Great job. My question actually is, in terms of choosing option strikes, Anthony, you helped out a lot when you were talking about the idea of how option strikes hold premium especially as they head into earnings. So, having an earnings in your strike, that's been really helpful. My question also is, does open interest play any role in terms of like choosing strikes? Is that something to pay attention to, looking at volume, those components? That's really something I was actually looking to find out a little bit more about when choosing the right strike. Looking at a chart, obviously I can see some prices that are in range, but should open interest be something to look at?
So there's a couple ways to think about open interest, in my opinion. For me, I look more so the underlying, right? Like I know that it's options are derivative, right? So they're the second form of this, like they're the bet on the stocks moving in a direction or the other, or not moving. But that to me is like means that I have to look at the underlying, because that's really gonna drive everything. So I know, for example, like here, like Fiverr, Fiverr loves to snap back after dropping a ton. And that's just the way that it rolls. And so because I know that kind of stock can move 100 in 2 weeks, then I look for, that high IV, because it has the earnings premium in it, which means that like, if I were to buy, like, I don't know, like I'll just go off the top of my head here, like Fiverr's at 218. I bet the 280s for earnings are like 20, 25, right? So like I maybe wouldn't buy it just because I don't know how many months, like 3 months it just had earnings. Those are pricey to me. But then there's something that like, it's not really about the open interest for me. I guess like open interest can be both confusing and both helpful, because it's more of a convoluted little like amount of, someone could buy 4,000 GME calls, right? You can have like high open interest at like 800 strike on GameStop and then cause a squeeze, but then, it crashes right back. And so it's for me, I always just like try to block out the noise of those different like Greek indicators, simply because I try to train myself to be able to do it without using them. And I think the one thing that helps me do that is by watching premiums all the time and watching stuff like that, watching things that will teach me that you buy it after the earnings if you want to play like a leap strategy, because it'll hold better at the IV, right? So like if the Fiverr 300s were like 5 for earnings, like that would be an attractive risk reward for me, because I know that even though it's 5 now, it may not have a bunch of open interest. There may be no sweeps on anything on the line or whatever. If Fiverr were to move up, then there would be open. Like people would be starting to slam it. Like people don't always like to slam things right at the bottom. People usually wait. Like a lot of buyers wait for the reversal, right? Like you saw a ton of sweeps come in Friday, like near the close, and you didn't see many sweeps come in Thursday, Wednesday, or Tuesday. So I like seeing like sweeps and like the flow of options. Like if people are slamming, if someone bought 20 million calls for 2 months out on Apple or something, like those kind of things are important to me, but not as important as just like the pure looking at the stock and knowing how it can move and deciding the strike, because I like to have IV on my side. And I don't really usually hold through earnings. I like to get out before, because once the earnings happen, the IV crushes and you have to be dependent on the stock doing well versus just riding the direction.
Yeah, that's extremely helpful. Again, I really appreciate that. Because also following Smarter Trader, he talks a lot about, obviously, he looks at the premiums, and he's obviously really gifted at that. But I guess you start to see, the value of the premium if something looks like it's getting, juicy, or looks like things are getting, that it could be also helpful in terms of choosing strike. But thanks again. You guys are awesome.
Absolutely. Yeah. Our pleasure. Happy to have you.
Yeah, this is really cool, by the way. We got to start doing this more. Looks like Jimmy Moop, I believe is how you pronounce that one.
Hey guys, thanks for everything you do. Anthony, thanks so much for all your advice.
Thank you, Jimmy. I see you on Twitter all the time.
You're the best, buddy. You're introducing me to SPACs, and it's been life-changing. My family thanks you so much.
That's awesome.
I was just wondering if you would mind talking about how you manage with SPACs between the public unit and the warrants in terms of risk management. And I don't know if you'd mind using a HAC as an example, HAAC.
Yeah, I mean, so happy. Like, that's a great question. And also, dude, shout out for all the support on Twitter. Thank you.
Thank you.
My biggest thing about that is, so I posted this on Twitter when I was doing it, just to give everyone the heads up. And I got a lot of flag. They're like, oh, well, the warrants aren't 1-to-1. Read the 0.36. Like most of the warrants, if you read the S1, are set up very, very similarly, right? Like, and you see that the skills warrants are almost trading at the same price at par. You saw the CCIV warrants went to 45 before they even had the ink of the deal done. So like when I had CMLF, I had the units to start because I was planning, hey, I'm going to hold these, for years and years. Like, what's the point of getting a warrant or this and that? I'm glad that I caught myself literally the day it announced. And so I posted on Twitter too. I sold my units at 29 or 28.50. And then I instantly bought back the warrants, right? Because I got the units for like $11, which is like, I can almost lose like very much, like no money. Like it's very like the $10 floor plus the premium that's going to be holding on the warrants. And there's no way, in my opinion, that they weren't going to get a deal because of the team being literally the all-star team. So you saw that the units went to 29 and the CMLF units, I think they had 1/4 or 1/3. So they had a little premium to actually CMLF stock. And if they're pretty much similar, I always go with the unit just because I know that when they rally, it'll be a higher percent, whether it's 5 or 10% or whatever. I'm chasing alpha, so it doesn't matter. I'm like looking for that little, like the pennies. That my mom always tells me that she's like, every penny counts and the pennies do add up. So I look for those, like, even if it's a 2-3% difference, like I'll take it because it's more money. So that's what I started with, is the units when they were both cheap. And like, I love the fact that the market's brought a lot of these down recently, and the ones that have done well, like CMLF, is still way over my entry. And like the warrants, because I sold the units at 29 and bought the warrants at 7, the warrants went from 7 to 5 to 6, whereas the stock or the unit went from 29 to 13. So what I'm thinking here is kind of maybe the process of SPACs I'm going to be using in the future is, of course, like the mix between the bonds are, you have like a few different ones in like NAVs, and then you have a few of like, I have a few in stock of the SPACs. And then I have arbitrage warrants, which I was catching, which still some of them worked on the dip, which was really cool because you had like 50%, 60% arbitrage. The arbitrage closes because the funds were long the warrants, short the stock or whatever it was. And then they came to par. And so now all these SPACs, we're all trading 27% over NAV for pre-deals, are now trading at 7%. So effectively like almost flat from NAV. And so that's giving you an opportunity to say, well, if the units are pretty much the same price as the commons, and the unit has like, even 1/3 or 1/4 and even 1/5, if they're like the same pretty much price, I start with units. And once the deal is announced, and so this is another thing, I don't know how the hype for deals will be in the future, because CCIV really kind of screwed the pooch in terms of like people were just so into it. And then, right, like people got confused with the pricing and the deal. Like it's actually I think it's a good deal, but people still were like, why is this 65? So that's kind of happened all over the market. That was the bellwether for all of this. Good to know in hindsight. But if that happens again, you'll see that the strategy works again, right? So those CMLF warrants went from 7 to 12 to 5 to 6, but in the whole time I had them, since I sold the unit at 29 or 28 and bought them at 7, I was always, first of all, I took out a bunch of cash. I did incur a short-term gain, but I would not have even been able to book that gain had I held it and it had gone back to 13. And then, right, like I don't have the warrants to hold me for 7 years or whenever they redeem to get the money back.
Thanks so much, buddy. Really appreciate that. You're the best.
Happy to help. Yeah. And that kind of just works for all SPACs too. Like HAAC is like kind of what I'm going to be doing, is I've been adding to a split between the shares and the units. And then I'm also kind of adding more in the warrants just because they've gotten down cheap. And like the same with FMAC and XPOA, like my favorite SPACs like that, AGC, Soaring Eagles, CMLF2, FMAC, like those are all really interesting teams to me. And those are all pretty much at par, like NAV. So those are ones I'm watching. And then just depends on the price, right? The risk reward, like you don't have to go balls to the walls with warrants. You don't have to go lightly. It's up to your risk,
Thank you.
Cool. And if other people, sorry, we still got like 5 questions. I'm sure people will continue to ask questions. If you guys weren't here when I first mentioned, raise your hand. I think it's cooler to kind of do this live. So
yeah,
it looks
for
like,
sure.
Yeah, it feels like a real radio show now. Ibrahim, sorry. I will unmute you.
Yo, what's up? Thanks.
What's up, man?
Hey, what's going on?
So, I had a question, right? Because, all these overvalued stocks or stocks that have run a lot in the past year, they're selling off now. And in the last podcast, you mentioned that because if they raise rates, that a lot of these stocks might get hit big, so they're gonna obviously exit before that happens. So I'm wondering if if and when we get to new highs and keep the trend going, do you think these stocks will get bought up as aggressive as they were before, or do you think it's gonna slow a lot right now because they exited?
Yeah. So this to me is like kind of what I was saying earlier about it being ambiguous. But what if I had a gun to my head thinking like what's going to happen, I think that this reminds me so much of October into November, right before we had the election. The market sold off 450 or 5, whatever it was, sold off a bunch, and then we just went vertical, right? And like things were moving that I've never seen move like that, and have never moved like that before. And so I think this is one of those situations where it's so new that it's coming, and it's the first time that the market's sensing, hey, there's something that could be wrong. And so I think it was easier before for me, and I think a lot of people, to decide what's going to happen next or think about what's going to happen next, because there was nothing that was like structurally changed at the time, right? But like rates factor into everything that happens, right? Like company goes to raise money, higher rates. They can't always make that cash back. Like they can't make those payments, versus if it's effectively 0%, they can lever whatever they want, right? And also investors, right? So longer term investors that lever cash, through bonds and this and that to invest in private equity or whatever it may be that has a longer time horizon, versus at 0% or 1.5%. That's going to be a difference in everything, whether or not. It's not just about the number, like the degree of it. It could go to 2, 3, whatever. Like it will get worse as it gets bigger for these names, but it's more so the fact that it's happening at all. So before it was like full steam, we're going 100 miles an hour down the road. Nothing's going to stop us. We're screaming through the sunroof like in that movie. But now it's like, hey, like it's raining outside. Let's see what happens. Is it going to clear up? So I think that if rates continue to go up, you will continue to see a crash in the NASDAQ, and you will continue to see drops in valuations and stuff, which is why like I'm actually starting to move towards like slightly more allocation towards like lower valuation companies, versus like I know that I love these ones that are more risky, that are going in the future, and I'm happy to hold for 5 years. But short-term dips matter to me, and I'm a trader, so I don't like being down ever. I like to protect myself in any situation. And then like as time goes on, you'll see these companies start doing what they're saying they're going to be doing, or continuing to do what they are doing already. And so I don't think this is like a tech is over because the rates have come up so much. I think anything that's going to be contractionary to the market will have a damper in the high growth and high PE, high speculative stuff. But I think that if you pick, once again, like it's just, if you pick good companies that you believe in and you have a proper risk allocation, and then like long-term conviction, if you're trading in the markets, like I would never be 100% cash or 100% invested, or like if you're trading, it's different than being invested. And so I'm holding these for years, and I'm okay to do that, but I know that there could be a lot of short-term dips. And so focusing a lot on hedging and focusing a lot on deciding what to concentrate in, because if it gets worse, I don't want to be caught holding a bag of something that just gets killed because it gets worse. So it's just like, I'm being better safe than sorry. Gun to my head, I think that they ripped these back. And I think that this stimulus bill and stuff was the buy the rumor, sell the news kind of event. And so they will buy bonds and drop treasuries, but yields, but I'm not positive. So I'd just rather be safe than sorry. So I've been hedging with QQQ, less so much with SPX and SPY, just because if the market drops, what I'm mostly in is NASDAQ and tech related stocks. So I'll be protecting myself through that way.
Gotcha. Thanks. And one more question. So Google is, is kind of one of the names that didn't really get bought up.
Strong.
And it's really holding up very well. And, it's popping when the market's popping. It's holding up when it's dropping. So do you think Google might be one of the catch-up names that can really rally?
I think Google should have been worth more the whole time. And it was actually like, out of all the big tech, like I was saying this to people, like I think Google was the one that was cheaper than Amazon and Apple and all this, like relative to like how much they're doing and how much they're really changing. And like no one really factors in the fact that it's a parent company, right? Like if you can split off everything inside of Google and and even keep it in the parent company, right? Like just think a Berkshire Hathaway kind of thing, which is essentially what they have. But if they spin off YouTube, if they spin off Waymo, these things are worth hundreds of billions of dollars each. And the fact that it's all bundled in together in this nice little, Google Alphabet, that's why it's like not, I think that's why it's not getting that kind of love that it deserves, right? Because like you hear about like Amazon and like AWS as being like such a huge thing. Like if Amazon spins out AWS, like it'll be massive. Like those are the things that I know are going to be happening in the markets over time. Like if this monopoly, like if people go after the monopolization of these, like these companies as monopolies, that will probably happen. If they're forced to spin off anything, I think overall value to the companies will accrue, like will go up. I just think Google has actually just been overlooked for so long, and people were tired of buying Apple up, you know, fivefold and this and that. So I think it was more of like a value play that deserved to be higher.
Gotcha. Thanks. And, you know, thanks for answering the questions, and also really love it, you know, in Sammy's chat, he always trying to help out everyone. So, you know.
Thank you. My pleasure, man.
Good work.
Appreciate it.
Thanks.
Awesome. Cool. So I'm seeing a few names that have been up there for a while. Pankaj Arora. Let me unmute you real quick.
I'll start answering the questions a little faster because we have a lot of hands up. Sorry. I get carried away.
Thanks, AO. Thanks, Avi. You guys can hear me?
Yes, we can hear you.
Perfect. So thanks for everything that you are doing. I just wanted to check on momentum plays with respect to opening. Are there any thoughts on what would be the opening plays? Reopening plays.
Mm-hmm. This is like probably the hardest question, just because like I was in booking at 1300 and I was in the rut at 120 and I wrote all those and I cut the rut like 200 and I'm only holding my, like the rest of my leaps, but they're like net zeroed out because I shorted calls against them just to free up cash and hold it for long-term gain. But I think that move has severely already happened, right? So I think that booking at 2,500 is absurd. But given the environment that we're in, like if I say that's absurd, I can't say that other things are not absurd. So everything's kind of absurd. It's we know this, right? We're in an expansionary move up. It's a melt up. It's foot on the gas. Like this has been that way for a while, but I do know that, right? Carnival Cruise Lines, people are like, oh, it's still 30, whatever off from the highs, right? They diluted it so much that it's still worth the same as it was before here at current prices. And like so many of their cruises are not cruising right now. And the same with Royal Caribbean and the same with like, you know, Boeing and like all these other companies, right? So I think for me, it's hard to invest in a company that I just don't even believe in. I love cruises. I love Royal Caribbean, Allure of the Seas. I'm all in, like, pina colada in hand. I don't like buying them though. Airlines, tough business, especially with like eVTOLs coming out of all sorts. And who knows, Tesla's going to make an airplane, probably, Lucid, probably. So those are the things that I have like issues with buying those. Like banks are freaking dead. I mean, like banks are dead. And like, I don't care what anyone says. People are telling me to buy banks. You guys are crazy, insane. And like, while it's been a good play because rates have gone back up, if you think Goldman Sachs, whose stock is down over a 10-year period, is going to crush it in the next 10 years with Square, PayPal, like the other 50 fintech names coming out. No, it's just not going to happen. So it's hard for me to even buy into a reopening play. Like one of my good friends, High Yield 6, told me, you don't buy shit. And so I used to buy UAL. I bought UAL at 16 and I bought CCL at 11 and I made money on them. And then I realized, what am I doing? You know, because there's some companies that are actually growing at like really affordable and like really better rates and that have like, it's a construct of revenue and margins and all this stuff. And those companies just don't cut it. You know, they're too capital intensive. They're too people, like just so many people. And there's issues with the traveling and this and that. And think about it, like airlines, for example, the more companies come out offering stuff, the cheaper they're going to have to cut it. They're already not getting by. They're going to die. Like, it's crazy things I'm saying, but I just don't see how that doesn't happen because the shift towards technology, the focus on efficiency and margins, right? Like I shared this thing about Lucid versus Tesla. First of all, like I'm the biggest Tesla bull ever. Like I've had this for like 5 years now, like custom made. Like trust me, I'm not a bear on Tesla. I was one of the first big bulls on Tesla when I was like 16 in my first pound. But Lucid's efficiency is 4.5 kilowatt versus like Tesla's at 4. So people are saying, well, it's not as good. It's all about one metric, right? It's efficiency, and that'll cause margins and that'll cause revenue. And so for that reason, like my reopening plays would be things that are tech, but also have a hardware component, right? Like I think Square is a really interesting reopening play, right? Because they have a bunch of, it's hardware and software, right? So software is not going anywhere. It will continue to grow. You will have quantum computing. It will be all about data, AI insights, machine learning, deep learning. Everything will be going on more and more and more over time. And then eventually singularity is going to happen, and who knows where it's all going to go. And you've got these, like NVIDIA's 250, whatever, 1,000 gigabyte supercomputer that's already rocking. These things are going to continue over time. And so I think that Square, will benefit from the trend of the software and technology, and like basically connecting people with the internet so they can do payment processing and all types of payments, but also in restaurants, in stores. And when people go, they will be swiping their cards through a Square reader. And I think that the demand is so pent up that when they do, they will be swiping it like they're going to be getting new cards every week. Because like I went on vacation and I like spent way more money on vacation than I ever do, just because I've gone nowhere in the last year. And so I think that when we reopen, those are the plays that are getting overlooked because they're getting like in the same bucket as like the high PE software stuff. Like, I think that that's incorrect. And so like that would be something interesting, and like anything along the lines of that.
So I'm laughing for two reasons. One, I don't know how you always have like something on your desk. Like every call we have, you're just like ready with something, like you're like a clown. Rahul Hemrajani. Let's go.
Unboxing.
There it is. Yeah, we could do it. Let's see. Unmute.
Avi, is there like, why can't I see this chat? Are people not in the chat? Are they just raising their hands, or
they're raising the hands, and then the chat? I told people to raise the hands instead.
Okay, cool. Because I haven't seen anything in a chat in a while.
Oh, good.
I wasn't sure.
Are you with us, by the way? Can you hear us?
Hey, yeah.
Awesome.
I think you already answered my question earlier. I
thought so too. I chatted you. Yeah. I was like, I think I answered. Okay.
Yeah, well, I don't want to take someone else's spot. I have a million questions for Tony, but I'll let him.
Yeah, let me get the first guys. No, I appreciate it. Thanks for.
Yep. No worries. Thank you guys again.
Thank you.
You guys are
awesome.
Our
pleasure, man.
Of course. All right. I've seen SK work up there for a while.
Yeah.
SK.
Yeah, SK works.
Unmute.
Riley?
Short Zoom. What's going on? Ask to unmute. Let's try like that. I don't know why that's not
dude,
working.
it's lined up, Avi. We're gonna have to put a cutoff for questions.
Yeah.
Like before it's...
All right, Kevin George. Let's see if it works. I don't know why it's not letting me unmute people now. There we go. Kevin, Hello. Can you hear us?
What's up, guys?
Perfect.
How's it going?
Pretty good. I got a question for you, Tony. So actually I have two questions. Just one was just a clarification. So I was listening earlier and you said options with earning premium at like far out expirations would get sweeps after a reversal. So the point is to like find those levels where you can buy in earlier, and then after a reversal, after maybe sometimes a price, then is when like big people would try to come in and buy out those option strikes.
Right. And you
because
saw that on
they
Friday.
have the earning premium.
Right. And you saw that on Friday, I think. And so like, yeah. I mean, the main thing for that is like, so it's hard because in two parts, right? If you try to time the market at the bottom with options, first of all, the easiest way to screw up is by having not that much time, right? In this volatile market, like we're chopping, and chop kills me. I really can't rock with chop that much. I have to sit on my hands because I screw up all the time. And like I screwed up all the chop in like the week prior just because we were chopping. And like it's easier for me to ride the market if we go down. So it's hard for me to pick bottoms for short-term calls. But what I'm saying is like when the market's rough, the best situation if you're looking to go into calls, I think is like the thing that has the least risk and still fantastic reward because the market's come down so much, right? Like if you were to buy a call for next week with no earnings, let's say the market goes nowhere or continues to dive and you're already down in your portfolio and you do that for 3 weeks, like I did. And then you keep screwing up and then you start losing a little bit more money, you psychologically start fucking yourself. Sorry. But like, it's like, you get into the zone of like, I'm going to keep messing up and I'm going to keep messing up. And you have to start to learn to sit on your hands. But then when you see the, like what you were saying about the sweeps coming in, some people like, it's not like, oh, now is like when we all go to do sweeps. Like people drop sweeps at horrible times. Right. And sometimes it's like literally to confuse you to make them go down and stuff. Like I saw like one of the times someone bought like 20,000 lots of ES 30 something 50s. And then it ripped a bunch higher. And then you saw the block on the other end over 10 strikes. So it's like, it's convoluted the way that the flows. If you could actually see what people's net positions were, it'd be a lot easier for you to determine what's the best flow to do. So then I completely like if I know I could get tricked, I don't look at it. And so I'd rather I figured out for myself. But I think timing the market and getting into the names is a hard thing to do with options. I think stocks is easier because you can slowly dollar cost average. And the way that I think about leaps, though, with earnings premium or even further is kind of the same. So it's not the same portfolio percentage I would allocate to versus like a 5% stock position. I do a 1 or 1.5% leap position, but that's the difference. That's way riskier. If that works, that will give me my 3 or 4% net portfolio gain. I don't need to risk 5 to make 25. I can risk 1 or 2 a couple times in a row, being very, very critical about deciding which ones I want to pick. I think I got talking about 5 or 240s on the pod 2 weeks ago, and that was into their earnings. They had come down a lot, nothing to talk with rates yet or anything. So I took the 240s and they went from 8 to 40. And then they went to they almost went to 100.
Yeah, I was actually in that trade.
Dude, good job. And maybe you held longer than I did because but see, that's what I cut out of those. But because it had the earnings premium and it was close to the time, and the market had just been getting killed and Fiverr just been getting killed. So I was thinking, man, pretty cool, because the closer it is with the earnings premium, the more you'll make when it starts to move, percent wise. So it was a really good setup in that way. So it's a time construct, but it's also, I don't try to time the markets. And if I do with leaps, I still dollar cost average. I don't just slam a bunch of leaps right then and there. I make sure I'm right, because that can go to zero.
For sure. Thanks a lot. Really like what you guys are doing. Long time listener. Continue to listen.
Pound it, baby.
Let's go.
I love this new segments. We got to do these a lot more. This is cool. I'll pop to the chat real quick because I think this is a hot question that a lot of people are wondering, because we love Kathy. But Mark Walensky is asking, do you think other hedge funds and big players are on purpose going after Kathy right now to try to ruin her?
Oh, man. Okay. It's tough, because what I think is happening is that Kathy has just become the poster boy for innovative high growth names, as CCIV became the poster boy for high valued SPACs. So it's hard to say they're doing it to her versus doing it because of her. So that's kind of the way that I think about it, right? People are oh, she has to sell and this and that, right? It's an ETF, and they were still getting 600 million in inflows Thursday when the market was being horrible. So I'm not worried about her having to sell and close up shop. That's not how it works. Will she concentrate her positions and move into the less liquid names that have gone down the most? And her higher conviction, TDOC, yes, she will. But I don't think that people are necessarily specifically targeting just Kathy. I think that they're targeting people who have exposure in these high growth names. And it's just easy to target because you know how much Kathy owns, you know what she's buying. You can almost mimic her if you're short. If you're short the market, at the top, Kathy would be the best person to short. That's just how I guess people are thinking of it. So it's the narrative that's combined with that. I don't think that ARK is a huge, it's not a conspiracy theory to take down ARK and this and that. Kathy's already won. Tesla did what it did, and she's best call ever, and she's crushed every hedge fund last year. If they're coming after her, they're coming after her because she's right and she's jealous, and they're jealous of her. And that's about it, in my opinion. But that does not go without saying that she is the poster boy for things like this. And I'm sure that people will be looking at her positions to see which are less, which have more of the flow taken up, right? Kathy owns 14 point whatever percent of NVTA and Twist. And then these companies are it used to be that, but of the whole company. So they're locking up the float pretty much. And so they can move it easily if they want to short stuff. And then if Kathy sells any, she just exacerbates what people are doing to her. But she's not selling and taking the loss. She's selling and reallocating. She's always fully invested. So at the end of the day, I say you are where you are. Every day, Kathy is where she is. So I think that she's going to win. That's just my opinion.
Cool. Xander, if you're still there, Xander Zimmer has got a question here.
Yeah, I'm here. First off, obviously, just like everyone else, thank you guys for doing this. Been really enjoying the content you guys put out. One of the major questions I've had, though, has been what's your process really for idea generation? With how much is going on, how many new SPACs are coming out, how many stocks are moving aggressively right now? What is really your main process say on today, like a Sunday, like I know you guys are doing this, but I'm sure you guys have been doing your research as well all week, preparing for the week. And just like, honestly, what does that process really look like for someone like you, Anthony?
Oh man. I mean, I think the process never stops, to be honest. Like,
I was in the lab till like 4 a.m. last night.
To be honest, I'm in the lab right now. Like I'm like half like reading something else that's like about style. Like it's just, it's always on, and you learn to multitask it because like I see things in the market. Like I see things in the terms of the market. So it's like you go to the store and it's like market stuff. Like it's like I can't turn it off. So I think it's the type of investor you are, I think has a lot to do with how much you like it. So if you love it, you're in there every day, you're on your screen because you love it that much. If you're like just an intelligent person, you're like, I want to create wealth and, build for retirement, this and that, then maybe you don't look every day and you just like research from time to time, maybe read the Wall Street Journal and like whatever. My process is like, I always have like 5 or 6 apps open and I'm just digging. So I always have my Trend Spider open, always digging through charts. I always have my Simply Wall Street open, digging through valuations, comparables, and I always use the Discovery tab going through new companies because it's just not all about what FinTwit finds. Like I think that I get caught up in all these names that FinTwit's talking about, and a lot of the names that go like the podcast is intended to be a podcast for the people, right? So if I see someone talk about a name 50 times, like and like it looks pretty good, like we'll discuss it and like you'll give it a research pound because it passes our preliminary DD. But once again, like there's just so many names that are being talked about that it's definitely overlooking some really good names that it could be smaller, right? So I go to the Simply Wall Street Discover tab, put in my inputs of what I want to look for, and that really helps me. And then they have like a valuation comparable thing, fair value pricing, inside ownership, share float, like all the kind of stuff that you want to see for like a long-term investor. And that's where I first decide like if I want to put money in that company, because I will not touch anything unless I like it. Like I don't care if GameStop's going to squeeze to $1 million. Like bought GameStop for an hour and I sold it because I was freaking out about how bad of an investor I was.
Yeah.
And even if you can make money with it, right? Like I tried to go to GameStop to buy Pokemon cards when I was coming from Miami to Key West, and none of them were open because they all had bars on the windows. I'm not buying that. So that was hard for me. But I go on the Simply Wall Street for the long-term, fundamental, like really understanding what the company does in terms of just like on a broad overview, and then seeing if it's like even worth it value-wise. Trend Spider, then see where the chart's at, see where it is relative to the NASDAQ, the S&P, other companies in the area. That's a big thing too. Look at competitors, because I don't like to be in something that can get eaten up by someone else. I think that's why like a lot of my picks are very like, or a lot of the names I invest in are very very unique, because I don't want to have a company that's like able to, just move in and take over my, like even Mealy, for example, right? Like I love Mealy, but I did not expect that another head of the table would come and start dominating in the area that Mealy's dominating in. So it's hard for me to be still super bullish Mealy when I'm already really, really bullish SE. And SC is going to start taking Mealy's pie. And I think Mealy will still crush it, but like SC kills everyone. So it's like when two heads of the table go together, you don't know what's going to happen. And then for me, for me, like I don't own Mealy anymore. And like I sold that months ago, unfortunately. Like I posted like how sad I was on Twitter because like I actually love that stock. But then SC just came in and just dominated. And now they're like killing the App Store. They're crushing Brazil. They're going to move all over. They're going to go to the US. I think all that's going to happen. So that's kind of how I look into companies. Like I want to see how they're moving relative to each other in the space that they're in, how unique it is, right? Like Nanox for me, I understand that there's risks. I understand if the FDA approval doesn't happen, the company is going to be pretty much worthless, this and that. And like, that's just how it's not initially, but if it never happens, nothing's going to ever happen with it. Right. So I think that companies like that have the potential to be super, super big in the world, right? Like there's so much cost in the medical industry that I am targeting a lot of like proteomics, genomics, med tech, all of that kind of stuff. And then, I think crypto is getting huge. So I'm starting to allocate towards GBTC and ETHE in my portfolio, and, looking into different things that are relating to like that kind of stuff. So very thematic based. Like I love space, right? So I own Helicity. I really like proteomics. I think that's like just so under the radar, and like ARIA and Kappa. So stuff like that I'm always looking for is just following the themes of where I see the future. And then relative to their peers, how much do I believe, like which horse do I bet on? Because how well I think, they can actually do, not just in their own right, but in comparison to competitors. Like Lucid is a perfect example of a company that is in just like a billion other EV companies are out, but there's not other EV companies that have this 517-mile range that have, funding up the wazoo like this. Like, that's why, these companies die, because they don't have funding. Like, look at the Faraday Future, the billionaire who blew up, like, kind of like dumb moves by him, but regardless, like, he blew up, he just didn't have enough cash, and Tesla almost went out because of cash. But Lucid's in a really peculiar position because their tech is supposedly better than Tesla's in terms of efficiency, which is the single metric that you should look for EVs. But also, there's the issue with that is, are they going to get enough exposure in terms of like people being hyped up? And they have, right? So that kind of passes my box. It checks my boxes for what I'm looking for in a company. So it's a big part of that. And then I swear I dive on Twitter like 50% of all my research, just because it can lead you to a bunch of different places, right? You can go to someone's Substack, and then you could end up watching YouTube videos. Like, I found myself deep in Reddit the other day, starting at Twitter. So it's just an information wormhole, and I love diving down the information wormholes, but always based on my themes after looking at where the market is and where I think it's going.
Excellent. Yeah, no, I really appreciate that. That's some great info.
Thank you.
Yeah, honestly, we'll be here next Sunday. Love it. Love your guys' content. Appreciate it.
Thank you. Awesome, man.
Awesome. Cool. And we got the chat back open. I must have clicked something off, but you guys.
That's what I was wondering. I was like trying to type.
Yeah, I accidentally hit it off, I think. Dominic, I know we've been chatting quite a bit back and forth on Twitter, so I had to give you a chance here to ask a question. So thanks for popping on.
Thank you for all you guys do, man. The podcast has been awesome. It's been extremely helpful. If it wasn't for you guys, I wouldn't have got into skills, which I'm trying to get up to my top 5 position.
Avi too.
Yeah.
It is.
So my question for you guys are, I have this internal struggle with investing in companies like Mealy and SC, which I have huge holdings. Mealy's my 3rd holding. Shop's my number 1. Where you can see that there's so much more propelling it with optionality and how they can expand, versus keep building my allocation in things like Nanox, which is now close to my top 10. And then I got things like Fulgent, which is only $1 billion, maybe $2 billion market.
You nailed that, by the way. Like, like that thing has gone insane, and it came back down to earth, and it's even more attractive here with their guide and their recent numbers. So, killer job.
Thanks. And so that's why I struggle with, is because if I'm trying to get these moonshots where I get 100 bagger and hold, because I'm investing, I haven't got into trading yet. Mm-hmm. Do I go that route and keep just doing little dinks and dunks like I just started doing butterfly networks, or things that are certain? SE can make new optionality because of what they can build out, like Amazon did.
I mean,
it's a tough one.
It's the question I struggle with every day. I mean, that out of all the questions, like, it's got to be the single hardest one for me is just like, what do you like? It's because it's all based on your goals, and it's like you have to be completely honest with yourself, and otherwise, like, I find that taking advice from a lot of people is hard to do. I think that the best advice is advice that tells you to look for yourself, and that's the advice I always like to give, just because you only really know the answer of like where you want your portfolio to go. But I do completely see the dilemma. I'm in the same, right? Like, I got hit by the value compression, but do I think that my companies are still the best ones to own? Absolutely. Like, I wouldn't buy them in the first place if I didn't. Right? You have to have the through and through conviction. And then you see these new ones come out, and like, trust me, I'm overwhelmed with the amount of names that I like now. And now it's like, I got to find the ones that I love, because when there's so much that you like, there ends up being a lot that you don't like, that you don't know about yet. So I'm always looking for the most things that are like the thing that's the most perfect in my like mind of a company. Like SC, I think, is just like gold standard, right? Like, I can't think of a bare reason for it.
30% is, I guess, the thing too, is like, you got Mealy, you got Shop, you got all these guys dropping 30, 40%, which we all know SC has been holding so strong for so. I'm like, yeah, I want to build on Nanox and all these other, but like, when am I going to get the opportunity to throw in a 30% discount on SC? So
yeah,
my own question, but it's definitely.
I get what you're saying now, more so. Like, so this is, I think of bigger cap stocks almost in like SPACs versus like growth names, or just like the NAV SPACs versus like the higher price SPACs. like when these growth names like SC and like Mealy is like, I think Mealy just went so far up and never really sold off that it has that big correction now. But if you just look at something like SC, right, like it went from 280 something to 209, whatever at the lows. That is a drop, but that's like a 25% drop or so, versus a lot of other names that have went down 40, 50, 60, 70, 80% even, just because the market's just oversold on every one of these names because they were overbought initially. So that for me is like, I've taken money out of my NAVs and I will continue, like with Ajax tomorrow, which I just don't like the deal. Maybe it's a head fake and I get screwed, whatever. I just, when in doubt, get out. But then I like seeing things like Nanox here at 40 or 32 the other day. I mean, like, I don't know how I personally, me, like, I thought that was a steal. Like I bought
Roll
it
the dice, right?
right. And so like, I get it. Like the higher the reward you're going to get is going to be probably predicated on the amount of risk you're willing to take, but it depends on the investor you are, right? So like, if you're like, you said you were 30,
36.
right? Like 36.
So
right, yeah, like you long time horizon, and you are investing in things like Flugent, who are killing it with their revenues and this and that. Like, I think that it's appropriate for you to do, if you feel like you find another name that you really like I don't see why you don't just like take a deep look into it and then compare it on like a valuation metric, right? Because SC, Mealy, and Etsy all went down 30%. It's essentially like you could have one of them, but just the one that you're more sure about, right? Like out of those three, my more sure about one would be SE. Yours could be Mealy, or yours could be Shop. The benefit to having all three is that whichever one wins, if all do, then you do. But if one or two win, you still do. Then if you pick one and that's the one that doesn't win, you're like, I missed the trend, but I picked the trend. I just missed it because of the company. And so that's a harder thing. So I've done that personally recently because all these heads of the table are like, they're all pretty much similar in terms of what they do, because, payment processing, like video gaming, like e-commerce have just gone up so much. I think that if that were to come down, I think all of those would be affected, right? So that's more so not concentration risk, even though like it's a large percent, it's sector risk, which is still kind of concentration risk. So I don't believe in the full thing of like diversifying across 50 different industries will be that. I think diversifying between what you're concentrating in, it's like almost counterintuitive, but have your things not all run together. Like when I used to have all five of the heads of the table, I would either do really, really well that week or get crushed that week because they all had strong correlations. I think correlation is a strong thing in the market that people don't always look at. But the reason March went the way it did was because everything was correlated.
Yeah, there's that good tweet.
Building on skills and STEM, thanks to you. So they were at 60% discounts. I couldn't pass it up last week.
Yeah, I added the skills on Friday too, right at then. I'm going to mispronounce this one too, but Kwabena Sarpong. Is that close?
Close enough. Kwabena Sarpong. Hey.
Perfect.
Hey, thanks, Abby. Thanks, Tony. Hey, I just want to point out, I think, Tony, you're a generational talent. I think you've heard me say that on Twitter. The people with the money, they should, I always say they should throw you a couple of bills, see what you can do with it. But I just want to say, like, the Pounder's Bible has been amazing. I started listening to you guys, and it just reminded me of when I first came to the States, like 1998 or so, and I read this book, The Motley Fools. And I was like, you kind of remind me of these cats, man, with just you're an ideas type of investor, and the way you pontificate about it is just really, really amazing. So keep it up. And Avi, man, I think you're the best talent scout out there. So
that's right.
Find us the next Tony, man. Find us the next Tony.
I got a bunch of them, man. We always joke that he's Justin Bieber and I'm what's his name?
Scooter Braun.
Amazing.
Thank you, man. So kind. Thank you.
Hey, keep being humble, man, because I think that's what makes you so great. Is that
I actually think I got out of my humility a bit, and I'm right back in it. So I'm happy to be back.
That's the markets, baby. They always let you know what's up.
And I got it, and I'm staying in it this time. So yeah.
Awesome. The question I had was, I remember I sent you guys a post on Twitter, and I was like, wow, from November all the way to like January, I was like up 300+%. And I was like, whoa, this is amazing. Right. And then February comes and I'm like, this thing's got to cool down. It's got to cool down. Right. So first week of February, second week of February, I'm like buying puts and stuff to hedge. Then I'm like, fuck, this thing's going all the way to 4,200, spot.
Oh, yeah,
So
yeah.
let's just keep spending. And then boom, things go down. Right. So the question I have for you is like, what's really stuck out to you? Like, what have we learned from all of this? I know that for me,
it's a good question.
I have to look at things from a month-to-month basis and try and protect that. Yes, it's hard to do in practice, theoretically possible, but it's like, how do you, and you've talked a bit about how you hedge. One of the things I took from you was buying things. I call it balls deep in the money. And that way you could withstand the short-term volatility, but it's something I've tried and it's really, really helped me in this downtrend. Of course, everybody's down, but I know if I was doing weeklies, I'd be finished, bro. Like I would have blown up my account.
I lost like a lot on weeklies in the last few weeks. Just like besides my hedges, like I did. So I guess what I'll talk about is my hedging strategy. So recently I've been hedging like either with NASDAQ or just QQQ. And so I just talk about Q. It's just easier to talk about how to hedge through QQQ. Like for example, like the market on Friday. Going into Friday, the market, we were like we had rallied back, and the NASDAQ or the QQQ was like 307 or something. And so I hedged the next day with 305 to 295 put spreads. So you buy the 305 and you short the 295 simultaneously. Right. I think I paid I bought those earlier in the week, but I'm just like giving you an example of like what I held through the week.
Right.
And those were, I think, roll downs from like it had dropped. Right. So I'll do like a $5 or $10 leg and I'll continue to add to a new leg as it goes down. And then I'll trim off the first leg. So I'm always cycling. It's like a Krispy Kreme donut bakery line, like you just take some off, you put some glaze on it and you move to the next one. And then each time your hedge gets more free. So when you bounce, you have that money that you saved up for a hedge if you manage your hedge properly. So like, let's say the NASDAQ at 330, right? And you don't know where it's going to drop to, like whatever. And you don't want to spend $5 out the money for a put because why, right? Like the market's been going up, but you want to hedge lightly and say, hey, like if we drop 10 or 15, I want to make some money on the downside. Say the market's at 330, right? Like for me, I start looking at like 3 or 4, maybe 5 points away, and do like 325 put, which is really like something that I'd be looking for. And hopefully it'd be pretty cheap. And if it's not cheap, the way to make money on hedging this is a very important thing. Market can get so pricey in premiums when the market's down. That's why if you're not hedged before you get screwed, you will get screwed in the chop because both sides premiums have gone up because the VIX is elevated. And it's harder to buy premium because the market is moving so volatilely that you think, like, hey, the market's going down, let me buy some puts. Those puts are 4 or 5 times what they were a week ago. So you're not even getting the hedge, right? Like if you buy an S&P 500 put at the money on Friday, it was like $30. Market has to drop 30 by the end of the day in 6.5 hours for me to even make $1. It's very hard. However, had you bought a put, like whatever, even at the money and shorted another one, like 10, 20, 30 points away, so you're creating a spread. You can cap your gains. Let's say you do it 30 points away. You cap your gains to that $30. And instead of paying that $30, which like think of it like this, it has to get to the bottom of your spread anyway for it to work in the first place. So why don't you just do the spread and layer it down? So that way you're never putting up the capital that it has to make anyway for it to work. And then think about the exponential fact of paying less and having the same move happen. So let's say the S&P is at 3,300. Let's say you buy a 3,800, 3,750 put spread. You buy a 3,800 put, you short a 37. First of all, go to YouTube and read, like, this is not to you, but it's just like in general for people, because this is like getting into the stuff that, like, if you do it wrong, it will screw you up. YouTube this, research it. It is called a put debit spread. Okay. Big. Just make sure to look it up, because if you have just the short leg open by accident, you didn't close it properly, like, unlimited losses potentially. So just make sure to do it right. If you do it right, it's incredibly safer for that like 30-point move than just buying the option outright. Because if it costs $30 at 3,800, right, and the 3850 or 3750 costs $20 or 15, so you buy it for 30. Since you're shorting it for 15, instead of paying 30, you're paying 15. But it only caps it to set 37.50. But why can't you do, like, as it goes down, just continue to add that? Then you can take off that part of your hedge and then continue to add more and more of the hedge. That works for like intraday hedging a lot. Overnight hedging, I like to have those set up. So I'll have the first ones and I'll have the second brigade, the third brigade, and I can do that over the days, over the weeks, right? Like the lower it is, maybe I'll give it more time to hit that lower level. Yeah. But I like hedging through spreads and then rolling it like in that form, because the problem that people do is when the market's crashing and they like to buy puts and they lose a lot of money because the premium is so elevated. And they don't even realize that until, like, I'll tell you why I knew the bottom was last Thursday, Friday, because when the market was crashing, my puts were not going up. I literally could not get any more gains on my puts. And I had to just cut them because I said, like, when no one's bidding on your puts, it's going to flip, right? It's all about premium. It's all about like OPEX. It's all about those kind of things that regular like buy and hold stock investors may not always think about because they don't have to. But that's the way I think about hedging. And the same can work for stocks, right? But the thing about stocks is that the S&P 500, you could have multiple, like it's Monday, Wednesday, Friday. And then like QQQ is usually once a week. So it varies, right? Like it could look cheaper for the S&P on Monday, but it's actually a better value to buy the QQQs for the whole week versus just one day of a hedge. So that is a big thing too. And the same with the QQQ for individual stocks. Like I look for that same strategy to be able to do the spreads on the downside, because if like, let's say like, I don't own Roku, but if I owned Roku and it was like 420 and I wanted to buy puts, it's like $12 or $50. I don't know what it is, but I'm sure I'm close. Like it's 12, 15 bucks at the money a week. And like, why are you going to spend 3 or 4% to hedge when you can do a spread, capture a 10% downside and spend 1 or 2% every couple of weeks because of a spread? I like to hedge through spreads. However, when the market does crash like hell, it's harder and you have to, that's when I do less spreads, but I like to cover the short leg of my spread fast if I see the market's about to dive. So I'll either cover it, or because that's short, another thing I've been doing recently is just buying an even amount of close to it, because hopefully the premium's like subsided a bit and I've already profited from the other leg. So I'll buy more like right next to it. Like if I'm short the 37.50s, I'll buy the 37.45s. That way it cancels out. It creates another spread. It cancels it out. So you're hedging your hedge to go, you're not hedging your hedge, but you're allowing your hedge to get full value. Anytime the SP goes to zero, you will benefit from that. And then when the market starts to turn, right, like you can close that entire position. Or what I did last week was the market was at 37.20. I thought we would pop like 100. I shorted some 37.40s against the, like not as many as I had long on the downside, but the market ran 100. So each of those contracts made $10,000. And, I did lose on my hedge because I was still protecting myself. I had way more puts long than I did short, but the ones that I was short were in the money. So when the market came back, I lost 20 or 30 on these options. But when it reversed, I made 70 net and I still had more hedge because I had like twice as many. So that's kind of like how I think about it. I mean, I know that's complicated. I'm happy to answer more questions.
I completely understood everything there.
Yeah. Thanks, guys.
That's wild. Sorry, did you have a follow up on that or no?
No. I mean, he's talked about this before on one of your podcasts. It's like he always says, it's complicated, yet it's something that you have to invest your time in if you're going to trade. So yeah, thank you very much, guys. I really appreciate it.
Anytime, yeah. And I think I think the logic of what I was saying was clear. So we'll record it and I get it. Like that was like a lot, but you can easily
get excited, and you keep going. Yeah.
I can't stop because I'm like, all right, like this is almost the end of the problem. Let me figure it out. And then
it's the Celsius, man. Yeah. It's the Celsius.
That's amazing. We got 5 Celsius comments in here.
Awesome.
We'll get that sponsorship one day here. All right, Riley McAdams. I've seen your name here for quite some time. I apologize if you're still there.
Yeah, I'm here. Can you guys hear me?
Yes, sir.
Hey.
How you guys doing? Thanks for having me.
Anytime, man. Thanks.
Been following you guys for about a year now. You guys helped me out throughout the year here. I have 2 questions. The first one being, so you started your own major. I'd like to learn a little bit about that. Yeah. So I've been trading for about 4 years and I'm still in college now, but I would like to kind of know how you went about the behavioral finance.
Yeah. So I went to Duke, and at Duke they had they had a program 2 option. So if you didn't like the majors and you wanted to create one specifically, you could designate like a head from multiple majors and create like an interdisciplinary kind of thing between, you know, multiple different departments and like specific niches within that department. So for me, I met a teacher who was really, really good at cognitive psychology. And I figured out that like psychology is just a construct of like the brain anatomy. Like cognitive psychology actually rules normal psychology because you can more so understand like the reasons for why it happens. So I was like, okay, that's definitely interesting. Like, and how it applies to people in groups as well. So cognitive psychology is like a big basket of psychology. So I wanted to combine that with finance, but I didn't pick the traditional, like I had to take Econ 101 and like, you know, the crap like that. And then I picked classes that were so anti-corporate, all of them. And I didn't pick a single one that was about like corporate finance or like I had to take corporate finance like abroad. And it was actually cool because it was like in London. It was like a super laid back, like actual guy who was in the markets and stuff. So it was like, it was like well done. And that's why I took it. But other than that, I took literally inside the hedge funds my senior year. And all these like classes that I think focus more on how people really think about the markets. And like, I'm a huge math guy, but I'm so big on like the 4D is just psychology, right? Like it's just at the end, like it's a joke for the idea of understanding the root causes of everything and the effects and the change. So that is like the biggest part of combining those two. And I think that when you can combine what people are thinking and why they're thinking about it with what's happening and what will happen because of what they're thinking about, I think you're unstoppable.
Yeah. So definitely the psychology is the big
I'm not biased at all in terms of the major, but I love the idea of, plus like behavioral finance was pretty much founded at my school. So I kind of like behavioral economics.
Kind of a trailblazer. Yeah. You're definitely a trailblazer for that.
Yeah. It was Dan Ariely did it. I mean, the guy's a legend and he did behavioral economics. And I was like, you know what, like I like economics, but finance is more my cup of tea. So let's do it.
Yeah. So for my second question, you guys might have seen my Twitter handle being Golden Bull Investments. So the one ticker that I think we both kind of know. You got any thoughts yet, or you want to dig a little bit deeper into that?
Yeah, I need to dig a little deeper into it just because there's like so many names that I've gone back into the drawing board in, and I'm like getting caught up in looking about the other names I'm in. And like I just reaffirmed so strongly like my bullishness for C that I'm definitely going to be like,
I think C's the best comp for Opera for sure.
Yeah, but I think that like, hey, it's not just going to be a single piece of the pie. Not one player in the whole arena. So
I mean Africa's kind of the target for them, plus Europe. But
right,
I think
and Jumia, as much as Jumia has been doing well and like growing and like becoming more of a logistics platform, and I think that that's going to propel them in the future. I think that obviously. Nothing has happened in that country yet. So there's so much.
I mean, it's all for the long term. Nothing right now, but over the long term.
But that's what I'm saying. Like, because of that reason, like anything that could potentially have a strong impact in that big of an area is interesting to me. So definitely going to dive more into it and like we'll probably do this again. So next week.
No. Thank you guys both. And Avi, hope you're doing well and kick COVID's ass here.
I'm trying, man. It's been a struggle. I'm trying these. I'm not drinking Celsius for those who ask. I'm drinking these immunity pills. Yeah, I'm not trying to dehydrate myself anymore. Awesome. Well, thanks, guys. We got a couple more questions. Tony, how long do you want to keep going on this?
I mean, I'm looking at futures now.
Why don't we? That's a good question. So we have two more people. We'll hit Cuevas Jr. and Sonny.
Cuevas Jr.
And then we'll wrap it up with that. Yeah, there was a question here about.
All right. Yeah. If anyone has a last minute question, like raise your hand now, and then we'll cut it at like whenever.
Yeah. Let's get these two, and then we'll ask about futures because they're starting to go down a little.
Hey, yo, this is Cuevas. Man, can't thank God enough, man, that I went into Sam's group and I met you guys. You, Avi, you, Thomas. Man, you guys have been great, very helpful. Man, I feel bad because I couldn't meet you guys down here in Miami. You guys came to Miami about a week ago, right? 2 weeks ago?
Yeah.
And man, I was working that day. Thank you for inspiring so many people, man, to be great, man, and stay humble.
Thanks.
Always. You're killing it, man. I'm actually your age, and man, you're my role model. I tell my girlfriend, man, every day. Like I promise you, man. I just hope that I can make it like you did, and man, can't wait for that pound at the table ETF in the future, man.
Man, I don't know. I don't know what to say, but thank you.
No, and
Thank
guys,
you.
especially you, Tony, I wanted to ask you guys. I know that you guys are long CCIB and in Anox. What are your targets for both of them in the next 3 years? I would say.
Mm-hmm. Yeah,
because my dad,
go ahead.
I got my dad into both of them, and he's like, "Hey, where do you find these companies? They are actually great." And I was like, "No, I found it through a guy I met through Twitter." Man, Twitter is killing it, man.
Twitter is insane, right? It's insane.
Twitter is. And no, I wanted to ask you guys, what are your targets for CCIB and Anox?
Yeah. So first of all, thanks for everything you said, man. All I can say is really just keep pushing forward. Literally just don't give up ever. And everyone says you can't do it. Like, it's all that cliche stuff is actually the truth. Like, just do it. Don't give a damn what anyone says ever, because I sure as hell don't. But what I would say about Nanox, I think Nanox has been doing all the right stuff and has been showing me that it's determined to be the company I thought it was going to be the whole time. And if you look at their projection, I believe it's 2024, right? So that's 3 years from now. Their projection is 1.2 billion in recurring revenue a year, right? So I don't know the exact, they haven't, it can be estimated, but we don't know the exact margins. But I imagine that the margins on a software as a service platform for a machine that costs roughly $10,000 is going to be skyrocketingly high. So if they do 1.2 billion in revenue, and they have 50%, 40%, even 30% margins, right? Easy 10 times multiple, because most things have at least, even Apple has a 10 times multiple and it's hardly growing. Everything has a 10 times multiple usually. And that's not like an inflationary period, right? If it's a profitable company that's doing well and growing quickly, 10 times multiple is pretty much my floor of where I think it's undervalued under that. So, right, 1.2 billion in revenue, growing with over 25% profit margins. Let's say if that's the situation, then times 10 is 12 billion, right? It's trading at what is it? 2 point, what is it right now? Sorry. I'm just just trying to walk through exactly how I come up with the targets, not just it's going to 47.
No, of course, man. Thank you. I really appreciate
it. Of course. It's a $1.8 billion company right now. So call it 2 billion at 40. If it goes to 12 billion, right? 40 times 6, 240. So that's kind of the way that I value things. I don't think it's going to get there tomorrow or today. I think if the FDA approval comes, the fact that they're producing 25 machines already and Ron is out there pushing and chugging, I'm a fan of that. So I'm still holding that long. I think that is completely dependent upon FDA, of course, right? Just because they can sell it in other countries without approval in some specific countries, I don't think that they will. I think that they're going to do everything by the book, just because of the level of which investors are involved, right? Foxconn Telecom or SK Telecom, you have Foxconn, you have a lot of big guys like Sony. They're going to make sure that they do it right. So that's why I think that they're keeping to go back to the FDA for all these things and pushing it as fast as they could. It's just obviously pandemic slows down everything, but for them to be even at this stage here and for them to be $40 and not back at 90 here with the news that people were all worried about not happening, looking like it's going to happen soon. And I think that valuation, the standard 10 times multiple based on their 2024, 2025 sales is an appropriate way to judge valuation. And I would figure the same for, what was the other stock? A CCIV. Okay. This for me
Lucid,
is,
man. I'm very excited with Lucid, because I know you were you being long for in Tesla. You're one of the biggest Tesla bulls I've ever seen. Yeah. And man, I think that CCIV can get somewhere close to Tesla in the next 5 years.
I think it's hard for CCIV to get close to Tesla, but I think it's easy for CCIV to make a name for itself already more than it already has. So I think that when you look at all these EV companies, like I said, it's all about their efficiency, right? They have the best efficiency projected, right? And those are not random. Those are cars coming off the lot and stuff that they're pre-production. Who knows? This is their first model coming out with it was the Dream Edition. This one doesn't have. I forget if this one has the 517 or this one has up to 503 if you dial something back. Either way, it's right in the range of the highest, if not the second highest on certain models in EV range. Efficiency 4.5 kilowatt versus 4 for Tesla per hour. It's a big deal because it's all about your battery tech, right? The amount of batteries that you can fit in, and it's also the size, right? If you look at the motor for the Lucid car, it's 3 times smaller than the Tesla car. If you look at the battery pack, significantly smaller. If you just look at the things that go inside of the car, the tech at the bottom base, the most important part of an EV car's tech is they crushed it. Like Lucid crushed it. And the problem that Tesla had with getting huge was getting funding and getting recognition. They don't need funding and they don't need recognition now for Lucid. Tesla has allowed them to see what mistakes would have been made had they been earlier, which will allow them to speed across plans way faster. I mean, they finished phase 1 that produces 34,000 cars. They're going to be working on phase 2, which produces up to 90,000 cars. I think that's all fake. I think it's actually higher numbers just because I saw it was 30 on one, 34, 37 in another interview. They're not positive, right? But because they're already working on phase 2 as they're going to be pushing out the first Lucids, they are not slowing down. They are going to be continuing to push. And this is one of those companies where I listen to every word that CEOs ever said on the internet. I watched days of videos and I picked up on all these little things that he said. And I just think that he's in the exact ballpark that I'm in and where I would take this company and how I would rock it. And I think they don't have to be the next Tesla. They just have to do what they said. And if they do better than what they said, we know what happens, right? Like Tesla's overpromise, underdeliver. Lucid has been overpromise, underdeliver until they got a SPAC. How are they not going to be overpromising, underdeliver, or whatever? The opposite. How are they not going to be doing that when they had $4.4 billion from a SPAC? Like they have all this brand recognition now. They have They have more than half the reservations they need to fill this and next year's guide for their cars. They're already done with phase 1, which can do 30,000 cars. Their guide for next year is 20,000. Their guide for this year is 577. It adds up to the numbers. Now you just ask yourself, look at the valuation sheet, look at the revenue, where it's going. Why don't they have anything to do with any electric storage when they talk every single day about manufacturing to OEMs to sell their battery? They don't say that anywhere on the revenue projections. Why don't they talk about their solar business that they're going to be getting into, which is on another slide, but not factored into the revenue projections? Because those are the things that Tesla added to give Tesla that oomph. You didn't know that was coming. And so when they did it, you're pleasantly surprised. So that means 2 things. They can just keep crushing it and then get valuation momentum. One, if something wrong goes, they drop the next product and it looks better. It's like if Apple screws up their iPhone, they drop a Mac or they drop a iPod or whatever. That it's like the same logic of that, right? So I think that has the potential to be in a comparable multiple to Tesla. My thing is, I need to know what the revenues are or the margins are actually going to be, because margins are a big construct of OPEX, and they have a ton of margins are a big part of the amount of money you spend first to put into the capital, and then see what efficiency you get out of doing that. Right? All their factories are super robotic. They can go through a car every 10 minutes, through 6 different jobs. It's extremely streamlined, and it's getting more and more streamlined. Their factory right now is only 999,000 square feet. It's going to be 5.1 million square feet by the time they get to platform 4, which will be chugging out over 400,000 units. So that for me is I love the game plan, and the fact that they bought 590 acres to be able to expand this, and then they can vertically integrate it with their battery plant production up the road, which they will license, in my opinion, to all the big retailers of cars, all the big manufacturers. I just think that they're doing all the right things, and they're not even really pricing it. People might be pricing it into the market, or they were not. I think now they're not pricing it in as much, but in my opinion, it looks like this thing is going to be able to have the potential to make actual moves. If they start coming out with accelerating battery production, if they can start doing 1,000 miles of charge, it's game over. No one's going to buy a Tesla. But if that means only if Tesla's not going to make 1,000-mile charge, right? If they can just find a way to get into that next realm of the EV 2.0, which is their entire mission, by the way, their entire mission. And I was listening to these interviews. He's like, we're going to get bigger, better as fast as we can. He's like, well, now phase 2 is going to come a lot soon. He's just using this money so strategically. He's building the infrastructure. He's going to start pushing out volume. I actually think he said it's delayed till the second half of the year. He said initially it'd be spring, which would be quarter 2. So what if it's just the beginning of quarter 3? And instead of only 577 cars, they got over 10,000 reservations. What if they just fill it because that factory can do 34,000 a year?
Very excited because I saw that there is a lot of institutional ownership too in that company.
70%, 71%.
Yep. Hey, another quick question. I'm sorry, guys, for the other ones waiting for the other questions. What would be a good advice? I'm a little stuck with school right now. I'm currently in college. I just finished my associate's degree. I'm currently trying to get into FIU. I don't know if you You ever heard about FIU?
Yeah, I know FIU. I'm
trying to decide what field to take, but economics is something and finance is something that I'm looking into. What would be a good advice looking forward into a career? I enjoy talking about the markets. I enjoy watching the markets. That's like my main thing, man. I wake up every day, 8 a.m., man. It just makes me happy doing and talking about it, man. That's my passion. And I told my dad, because I was taking something else, and I thought, because of my mom wanted me to take something that, you know, I used to like as a kid, but man, I don't feel
my mom wanted me to be a lawyer. Like, it is what it is.
Yeah, you know? So no, just asking for some type of advice from you, that because you're, like I told you before, you're someone that I admire in the stock field, in the finance world, and all that. So
yeah, I would tell you that what I did in college was like strategic for the future, because I decided to take the classes that I knew I didn't want the information from, but I wanted to know so I could use it against people later, right? Because whenever you're going into an industry, it's the guy, maybe you know what's being innovated on, but if you don't know what the first innovation is, maybe you know what's being innovated on, what's being innovated, but you don't know what's being innovated in the first place, right? So like, I didn't understand econ. I got options, right? The derivative of econ. So I think it's important to understand the actual backbone of the economy, the financial markets, bonds, like all those things that factor into every decision, right? Like it's very important to look at the top down approach, right? These first principles, it's the most important thing. So I like when people go, like, for me in college, I like to pick between the things that I really wanted to know. I wanted to know about people and how they interact with the markets. And then I wanted to know like the not so standard, but still like in the industry finance I could. So I took a mix of classes between that. I don't know the major offerings there, but I mean, like, I did behavioral finance, which combines psychology, which I think psychology just like teaches you so much. But the benefit of these things is a lot of it you don't have to learn in college. So I say, like, do what you love and do what you want in college. And if you're going to get bored as hell doing anything but your passion, don't do anything but your passion. I mean, like, I don't believe in safety nets. I believe in going for what you want.
Thank you. Thank you. Definitely, my man. Man, God bless you guys. Keep it up, Tony.
Bless you too. Thank you.
Abby.
Thanks, man.
You guys are great, man. Hope you feel better, Abby.
Appreciate it. Thanks so much, guys.
All right. Last question.
And I think we'll wrap everything up kind of by 9.
Yeah. It's been 2 hours. It's been a while, but man, it's been fun. My voice is
You're
hoarse,
the man, Tony. I was like, thank God. Sonny, can you hear us?
Hey guys, thanks for taking my question here. I had a little bit of a problem with my mic.
Oh, no problem.
We're good now. All right, so man, I've got maybe 50 plus high beta tech positions, way too many positions to keep an eye on, especially with the drawdown. A lot of them are down 20 to 50%. And I think my low conviction stocks are hit the most. So how are the charts looking? Because, I missed the first 10 minutes, 15 minutes.
Oh, yeah.
Because I'd really like to consolidate into my top long positions and get out of some of these sort of like names I was basically chasing. Most of my SPACs, a lot of these are SPACs, and I own them at around $10 to $15. Some of them went to 25, 30, 35, 40. And a lot of them are down to 10, 11, 12 bucks. It's pretty crazy. So hopefully, if we can get a few rips, I would like to just go back into my long-term names and get out of some of the names that I don't love as much.
Yeah, no, I've had that same situation happen to me. Like, I think that the only difference is, like, I really only have been buying names that I really like. Like, just deep through and through, that I've like done the research on and I've enjoyed, and it's just actually been overwhelming for me as well. I think that we've had the problem with choice is when there's too much of it, right? So we've had too much of it, and there's too much choice between good things. Now you have to find the things that are great. And so with 50 positions, the statistical probability of finding something that's really, really great in that is high, but like, especially if it's like in the ballpark of the high beta names that have projected revenues, projected, incomes in the next year or two. But I think that there's a lot of names that have projected revenues that are coming 2023, 2024, even though they might be amazing, the market's not going to give it the time of day right now. So that's the hard thing. And that was just like that was, when was the shoe going to drop? And everyone was thinking 2024, myself included. I did not think that we would get this big rate rise after the 7-year. I'm not that huge of a bond guy. I recently became a big one. But what I do know is that concentration is a big deal in terms of actually making gains and keeping them too. Because if you have 10 positions, right? Like let's talk Ackman's strategy. He buys 10 stocks, 10% about each, and that's it. But with that, it's really easy to hedge, right? You could just hedge each individually, or you can hedge half of them. You can, hedge through VIX, and it doesn't need to take up that much because he splits it up between different industries, and there are companies that have revenue and profit and this and that. So that's the thing. That's that's one way to do it. And I think that makes that. And then you go in the middle of what you're doing with 50 is like kind of where I'm at right now. Like I think I have anywhere between 20 to 35 or 4. Avi, we have to unmute him. Are you muted or are you good? Okay.
Yes, I'm good now.
So cool.
Good now, thanks.
So yeah, I mean like anywhere between like 20 to 40 positions I have. And like, if it's higher than like 30, it's because they're like markers, right? So I like to mark stuff. I buy like 1 or 10 or 100 shares of something and just watch it move so I can learn it. So if I'm thinking about getting into something, like I'm almost right there to make a big position, I'll do that. But I think a big deal of it is if there's so much going on, it's hard to actually stay the course because there's no way you can believe in 50 names the same as you believe, for the best one in those 50. So I think, like I like to use math, so I'll just make it easy. Like statistical probability means if there's like n equals 30, right? Like n equals 30 is like if there's over 30, like just give or take 30, then you have statistical probability of your account moving one way or the other. If you have under, you can have like unique results, and that's like right. Like what is it? If the P is low, reject that. Whatever, the word that you learned in college. So the lower amount of stocks allow you to have more concentration. And if those do really, really well, then you'll do well over time. I think it's hard because 50 positions, if everything is getting slammed, you're just going to feel like shit every day. And like, I know that because I'm like kind of been there and I was there. And the reason you got to 50 positions is because like the bonsai, it got somewhere in there where you were either, not trimming enough of the things that have ran too much to allocate to the core, or, you saw there was too many opportunities. So you got overwhelmed like me. I'm not even dissing on you at a second. Like I did the same thing, might have done it worse. Like I did it badly too. But that's when you have to really hunker down and think, what do I really believe in all these companies? And if the market does tank this is the answer. If the market tanks another 1,000 points, what are you going to be pissed off holding?
There's no conviction names. And I knew that.
You don't believe in something, you don't believe in it.
Yeah. I really don't want any short-term plays, to be honest. I don't mind trimming. I have been trimming quite a lot. And the high conviction names, like just to name a few, IPOE, which is merging with SoFi. You've got GHVI merging with Matterport. You've got Ride, which is already completed their merger, which is Lordstown Motors. Some of these names, I can see that they most likely will perform because they just don't have. There's not too much guesswork. Like, do they have factories or do they have revenue or will they have revenue? But there's tons of other names. There's so many names. But some of the other ones, and not to diss on any stocks, but like LOTZ, even CCIV at like really crazy numbers when it went to like 50, 60.
Right. Yeah. I mean, that was insane. Insane.
I stayed the hell away from it. I only bought it at $13, and it went up insane, and I sold it, and then I got back in at $24. So
good job, man. You did better than me. I mean, I literally only trimmed a third, the warrants over 40, and then I had to write puts on the way down and still lost money. But I am holding it for over like a year at least. I want to see, like, I'll start selling when they do 100,000 cars a year. So
yeah. I mean, like Desktop Metal, which is DM. I bought it late in the game at $16. And it ran up to 30 something. It ran up to like 34, 35, I think. And I must have sold between 30 and 34. Same thing with
dude, do you need a job? Like
HIMS, like HIMS, same thing. I got kind of lucky because I love the name. And then Kathy Woods bought it and it just shot up to $28. My cost was 14, so I sold half of it. And then a lot of these positions, when they double, I sell half, and then I start buying on the way down. Geez, I've been buying the last 3 weeks, and every day there's a better price point. Every other day it's a better price point. And now I'm 96% invested. I don't want to add any cash. So I'm just kind of figuring out what, hopefully I get a chance, because my high conviction names are okay. I don't mind if I'm down temporarily, but the low conviction names, I'm getting destroyed on them. So
yeah,
I want to get the hell out of it.
I think what happened to me as well, and it happened to 99% of the people on the markets recently, just because I have never seen a situation where, like you sit there, you wait, right? You wait for good companies to come out. You wait for the next big one, the next Amazon, the next Tesla. Then you have 150 hitting the market in like 3 weeks, 3 months, and you just don't know what the hell to do, upside down, this and that. And so I think the first thing I want to say about the SPAC thing is a lot of that was obviously the rate and the value compression, but on top of that was arbitrage catching in the SPACs, was people from from investments in the SPAC making sure they don't lose their money. So that for me might be a situation where I don't know if that's going to happen again, right? Is it going to be a cycle where they explode it and then they catch the arbitrage and warrants? Do they explode it? And I don't know, but I do know that like Skills, if you look at Skills, for example, held super well because post-merger that company's made a name for itself, and it's not a SPAC. Okay, a SPAC is a SPAC until it changes into a non-SPAC, right? And then like Skills is a company now, and Skills held up super well. And so like for me, like that shows relative strength, and like I like that I have a position in Skills because of that. But like I'll give you an example. Tiger is a position that I was in, like we talked about on the podcast at 10, as like a better alternative to Futu, which was at 100 and had already gone 250%. Right. So for me, that was a risk reward play on valuations. However, now like, it's still at a double. It was at almost a quadruple, or triple. What do I do here? And I want to wait. I still own it. I want to wait to see another quarter to see, like, are they going to be growing as fast as they've recently grown, because they are a newer company. So sometimes I give things a quarter or two to figure out and see what they're going to end up actually doing. But I do like, a lot of people will always say, like, when the markets are shaking, when you're in doubt, concentrate in your like, your highest conviction holdings. And also, like, I would just say, like, in general, I am a big believer in not buying things that you don't believe in strongly. Like, if you can't tell me in a sentence why you don't like a stock or why you like a stock, then you shouldn't buy it. That's just my opinion of like you should know why you like it, and if you don't like it, then I don't know why people own things that they don't like. But it happens, right? Like you get a lot of FOMO, and I fall into it too. And it's just like, you got to breathe. You are where you are, keep the tree alive, and trade another day.
Can I ask one real quick, just real quick, is all the pre-merger SPACs, like real quality pre-merger SPACs, like RTP, RTPZ, I'm all of them. Some of them are actually, again, FOMO chase to $14, $15. Most of them are between 10 to 12. But all of them got clobbered. And even after they're merging with decent companies, but at ridiculous valuations, most of these SPACs we were seeing between $2 to $3 billion valuations. Now everything is 6, 8, 10, 15, 20.
Well, yeah, I mean, and I think that's nuts. The glut. That's the reset. Because now, so for me, something big just changed. Ajax should have gotten a hell of a better deal, right? And I don't think that they're that stupid to pick that company, because I would have picked a 20 times better company, and like 99% of the people on Twitter would have picked a better company, because
absolutely,
you know that used cars, right? Like Vroom, whatever that name is, has been getting clobbered, and people are not interested in like Hippo and like all those different companies that are like insured, like hitting the market. It's just people are not into that kind of stuff. And so what I was thinking is like, why would they bring out this like used car buying platform, and then like, hey, are deals drying up? Are all the companies in talks? Like, is there going to be one last push of 100 IPOs before people are like, hey, like, we can't do this? Last I checked, there were over 300 private companies worth over $1 billion. And this was a few months ago. I'd like to cross-reference and see how many of those unicorn beast companies already went public, to see how many more are still available, and then see how many more will become available. I'm sure there's a number. Actually, good idea. I'm going to write it down. I'm fine. Figure it out.
Yeah, I usually look up these companies on like Crunchbase or another or similar website to make sure what was the last round at, and especially this the Ajax company.
Oh crap!
Oh my God, the valuation is. I think it's like.
Well, they took it to
an
8,
order
7,
of magnitude higher than.
It was 1.5 not long ago. They took it to like 8 or 6, or I forgot what it was. It was so high I didn't care. Like I didn't continue to read it.
Yeah, so I wish I had found your guys' Twitter and the Bible a lot earlier, because I'd been doing all the homework myself since September, and I only came across you guys in January. So hopefully, well, I think you guys are going to talk about charts, right? So I don't want to keep.
Yeah, we'll definitely. We did some charts earlier, but I think I might have to be. Avi's got COVID, so like, I'll use the Avi card. Yeah, the excuse.
No, I think we should wrap it up. This is our first time doing it. We decided to do this. I think.
Big ups to Tomas. Thank you for helping us set it up. Tomas is the man.
Thank you very much, guys.
He runs an awesome trading room. The guy crushes it. So give him a follow at Tomas Colson. He's the reason we have a Zoom set up today.
Yeah. So no, I think this was super cool. We've never done this before, obviously. This will be a new format that we can try out on occasion. I think this is cool. It's really awesome for us too. Like genuinely, it feels like a community now that we're building. And so
this is
happy
fun.
You guys all joined. As always, Tony, though, we're gonna have to wrap it up with like thoughts for the week. Obviously a lot going on here. So why don't you give us kind of the thoughts for the week, and then we can wrap it up. And
let me just muster some stuff up. Like I'm running on fumes right now. I've been talking for hours. So let me think for a second. I think the market, really 1 second. I think the market's in a place right now where I can't say for sure that I'm bullish, and I can't say for sure that I'm bearish. I think mean regression works both ways in a different time frame. So I think that because we rallied so long for so long and so hard, and I think that because we've dropped so fast and so vigorously, and so like the arbitrage between the SPACs are closed, the NAV over premium are closed. And I think that that's a huge indicator for liquidity flowing in the market and people wanting to be aggressive in the first place at all. I think that the reason a lot of them got sold off too is people selling those NAVs to get into other positions that are sold off, right? Like you saw the biggest inflows, I think, in the S&P in a long time, Thursday before Friday, which this is like, I think at Charting Options on Twitter, I wrote that. So I was like, that's really cool. And then obviously we reversed the next day off the VWAP. I think the biggest thing here is to see confirmation follow through of the NASDAQ over 13,100. That needs to happen. I need to see consolidation of the rate 10-year go down, and I need it to go under 1.4. And I needed to stay under 1.4. If it goes to 1.75, look out. If it goes to 2, look out. If it goes to 3, get out. I'm scared if it goes to that high level, right? Like things will get bad. It's a big deal because I don't think it will. First of all, I'm just like saying you worst case scenario just to be prepared. That could totally happen. Like the only reason I'm saying it's bad, right? Like someone just commented, like totally agree here. Like rates ran during 2009 and 2020. I don't disagree. I actually said earlier in the pod that 1.62% really appropriate for like a strong economy. However, how fast does it happen? And like, does it shake up the already like structure that's not so great right now in certain parts of the economy that we don't have all the full picture of because so much money is flowing in and out, and there's inflationary pressures, deflationary pressures. We're not sure, right? I can't say I'm sure. If there's a genius out there who's sure, I'd like to meet him, because I would like to know. But I'm not positive. So what I would say is I think that over time, I don't think the Fed's going to raise for years. I think that that's bullish. I think the Fed always says that they're willing to do whatever they are capable of to maintain the status quo. And they didn't say they would do twist. They hinted at, not Bullard. Bullard said, Operation Twist not on the table. But Powell, when he was in the speech, he said, when he was asked to, are you thinking about buying and selling different direct, which is twist. Operation Twist is buying down, selling the different treasury to fix the curve, basically twisting the curve to make it look right in terms of the short versus long-term bond durations. But if that's stolen, you can always do that. And I don't think you need to do that, but I think the market is understanding of the Fed will be there because it has to be there until it's over, because that's what they've been saying. So I think that the biggest things that are impacting the market clearly are, right now, these rates that are not because of the Fed. And I think it's an overshoot for what's the stimulus that just happened and the recovery of the economy. And maybe COVID will be over in a month or two. Do you think you're going to stop using Netflix and Roku and Amazon? I don't think so. So I'll say is like, zoom out, folks. It's always prettier taking the longer view.
Love it. And that's where we wrap up in the real show.
Yeah. And
so
then it's
honestly,
like, oh my gosh, I was pounding the table. Yeah. And then it's like, yeah.
we got to get we should have had the live music here. Honestly, thank you guys so much. If you guys do have questions, of course, shoot us an email. It's theboys, THEBOYS at poundingthetablepodcast.com. We'll post it on Twitter too. So if you guys have like questions, email us or comments or anything, how we could do this better. We thought of this like 20 minutes before we did it. So hopefully people enjoyed it. And
this was all completely off the dome. And I had a great time doing it. And I'm happy to do this again and again. And maybe we'll do this, like we'll substitute a podcast every other week for one of these or something. I don't know. We'll see. It's fun. So thank you guys for coming. Stay tuned for more.
Yeah, I recorded this as well. So I'll figure out a way to get this out live for everyone. So thanks so much, guys. Bye.
All right.